Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Ryan Sudeck. He is the CEO of Sage Investment Group, a company that transforms hotels into apartments in growth markets throughout the United States. They recently began their 22nd hotel conversion project, I believe, in December of 2024. And before Ryan joined Sage, he served as Vice President of Marketplaces at Redfin and previously led acquisitions across industries at PwC, Samsung, and Amazon. Ryan, thank you so much for being on the show today.
It's a pleasure to be here. Thanks so much for having me, Charles.
So give us a little background on yourself. Before joining Sage Investment Group, you were with Redfin, some other groups. Tell us a little bit about yourself, both personally and professionally, prior to what you're doing now as CEO.
Yeah, happy to. I'll go way back to my youth. I'll keep it quick, I promise. So growing up, I grew up on the East Coast in New Jersey. My dad was actually a pilot by trade, but had always had a small portfolio of real estate. And so on the weekends as a kid, I was, swinging hammers, soldering pipes, installing toilets, snaking drains, doing all the dirty work because, he always did the work himself. And it was just a couple properties in our hometown of Medford, New Jersey. And so it was a really formative experience. Like I said, my dad was a pilot post 9/11, took a massive pay cut when the airlines went bankrupt, lost his pension. And, having that passive income from the real estate really allowed my parents to kind of survive and, then eventually start thriving again, through some challenging times. And so, for me, I knew I always wanted that for my family, when I got to that place one day. So fast forward, moved out to the West Coast, went to college, met my wife, went into corporate America, as you mentioned, did a lot of work in mergers and acquisitions. So instead of acquiring, a real estate asset, we were buying companies. So worked on deals like when Amazon bought Whole Foods, when Samsung bought Smart Things, the IoT platform, or Loop Pay, which became Samsung Pay and, powers payments on, hundreds of millions of phones around the world. So got to know, a little bit about a lot in business, got to understand underwriting deals, and then eventually started doing my own real estate investing. Started with a 6-plex value add, did a lot of the work myself. Ended up doing cash out refinance, got an 8-plex, sold those, then a 16 and a 30. And then fast forward to 2020, that's when Sage Investment Group got started, where I'm now CEO. At the time, I, was working in M&A. I'd been working at Redfin, actually leading not just M&A and business and partnerships, business development, but also operating, real estate businesses, within Redfin, all of their digital revenues businesses. And as Sage came together, I went fully passive with my investing. So I took my 16-unit and my 30-unit property, moved it into Sage's fund as we were getting started in exchange for shares, and then just became a passive LP in Sage's Evergreen Fund. And then, I was fortunate enough that about 18 months ago, ended up joining the company full time as CEO and as one of 3 partners here at Sage.
Wow, that's quite the story. So when you start off with those smaller ones, you self-managed everything, even like those 16 and 30 units?
Not the property management. Certainly the construction management up front, I was doing myself. But I leave it to the experts to handle, screening tenants and collecting rent checks and dealing with the, the overflowing toilets in the middle of the night. It's the same thing we do at Sage today. We work with the best, local property managers for our projects.
That's awesome. Yeah, it's something I want to get into a little bit more as well. But that was one thing that I found when I was starting my multifamily portfolio kind of business was that, as I was able, when I brought in third-party management, it just makes everything so much easier, because it's one thing about handling that, with the value add portion of it, or, the renovation, getting it rented, all that kind of stuff, and then handing that off and having that property manager there to assist you with, but also something where you can pass the keys off and now I'm on to the next one kind of a thing. And change your roles into really sitting in that asset management seat, which makes it a lot easier because you want to really control costs and everything like that. And I don't know if I would trust a property manager to do everything for me on a long project like that. I think it would be something like you did, is where you're there, you're doing some of the work yourself, and then also you're dealing with all the contractors and you're making sure that you're getting bids, everything's getting done. It's one thing having a property manager do one-off projects, overseeing them, you know what I mean? It's another thing for having them take care of a 3 or 4 month plus plus renovation process.
Totally. And especially these projects, these properties were totally vacant when I took them on. And so, there were that monthly cost, the CapEx going out the door. I certainly wanted my eyes and control over that to make sure it's being managed properly. But totally agree with you that, having that intense focus up front, but then, kind of turning over to the experts to deal with the day-to-day is a great way to operate, especially as a retail investor.
Yeah, for sure. I definitely agree with that.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com.
Can you give us a little background now on what Sage's investment strategy is? Because this is a little unique versus other value-add multifamily operators that come on the show. And kind of what's your strategy and what's your criteria for investment?
Of course, yeah. So we're taking hotels and converting them into apartments in growth markets across the country. Our mission and our goal is to help address the affordable housing crisis by creating these naturally affordable units that are brand new and renovated in markets, and they're located where people live and work. These units appeal to folks who, make good wages. They make too much where they don't qualify for, government help, but they don't make enough to afford the brand new Class A building down the street. But in our community, they live in something that's been totally renovated with a lot of amenities because we take those hotel amenities and repurpose them. We're a developer. We do all of our own construction management. And so it's a heavy lift to transform a hotel to an apartment building, but the value that it unlocks is pretty incredible because, we're buying at a hotel cap rate. And for those who don't know what a cap rate is, it's a valuation metric. A simple way to think about the difference between value of a hotel and an apartment building is maybe just a revenue multiple. So a hotel might be worth 3 to 5 times the revenue it generates, whereas an apartment building will be worth 7 to 12 times the revenue that it generates. So when we were able to buy these hotels, do a lot of heavy development work into them, it's not easy to capture this arbitrage and value that exists. But once we do that and transform them into apartment communities, we see at least a 50% increase over our cost basis in the value of the property just because of that transformation.
Wow. Yeah, that's pretty amazing. So when you're looking at different properties, what does a typical hotel acquisition look like for Sage? What are some of the important elements that need to be present for a hotel conversion deal to make sense and to work out for you guys?
We want to have enough units on site that we can have, or units in the property that we can have on-site management, that we can get scale over our construction costs. So on the low end, we're looking for properties with at least 100 units. On the high end, 200 units. And we typically don't go higher than 200 units because we don't want to oversaturate the market with studio housing. We're typically taking whatever the hotel gives us. If they're just, typical hotel rooms, a studio, right? We're not usually combining units because you can't double the rent for a 1-bedroom that you'd create from 2 studios compared to what you could rent just a studio as. So that's the first criteria. So 100 to 200 units. We're looking for markets that have strong wage, employment, population growth, because we want to make sure that we have a good tenant base. These properties are really well located, near where folks want to, or where they work. And so we're looking for good locations with job centers nearby. On top of that, it's all about the price of acquisition, making sure that we feel good about that. We're starting to get a pretty good handle, after doing 22 projects, or at least starting 22 projects, as you mentioned. We're getting a good handle on CapEx per room. We've learned a lot there. We've been able to value engineer. It's actually our competitive advantage, I think, in the market, because we're saving on materials costs, getting supplies in bulk. We're optimizing our labor. what's really important too when we're buying these is also working with the local jurisdiction to make sure we can convert the asset. So it's not just what is the profile of the asset itself, how many units does it have amenities, is it exterior corridor, because that's what we're typically working with. But the other set of questions, and these are sometimes harder to answer, is can we convert this? Is the city going to allow us to change it from commercial, hospitality use to residential use? And so, we've got, a team internally that focuses on, really helping educate the local jurisdictions about what we are, because we are unique, to your point, and not a lot of permitting and planning offices have seen folks out there doing these hotel conversions. Luckily, with our track record and the success that we've seen with some of our projects, not just helping solve a need for affordable housing, but on the broader community, we're able to usually grease the skids and get through that process. Okay, there's speed bumps along the way for sure, though,
because you guys are in so many different kind of locations, several different locations, states. So I see that being a little bit more difficult with dealing with the municipality, zoning, and permitting. What is one way that you guys kind of structure your deals so you're not purchasing a property that cannot be converted?
Fantastic question. So we're very upfront with our sellers. We've got a strong reputation about closing deals, but we need to close it with certain conditions. It typically takes us about 6 months, sometimes longer, from when we go under a purchase and sale agreement to when we close on the asset, because we need a few things. One, we want the property to be vacant. We've had issues with hotel guests asserting tenancy rights and having to go through the eviction process. So we've learned, we need these properties vacant because we want to start the renovation day one and get them into an apartment building as quickly as possible. The second thing we ask for that takes a lot of time is a change of use permit at a minimum. So that change of use permit is basically the local jurisdiction saying, yes, you can change this from commercial to residential use. That allows us to start construction on day one, because we want to close, we want to secure the property, and then we want to immediately start, the work of removing the old and then eventually, putting in the new.
So when I've spoken to contractors who have, worked on hotel conversion projects, and they've told me that it usually costs tens of thousands of dollars per unit to perform a conversion, they were saying mainly the electrical is extremely expensive. What does your inspection due diligence process consist of? Since, construction budgeting is really paramount to this whole thing working. It's not just like we're going and spending a few $1,000s and we can do that month 12 or month 36, during a value add process. We're doing this all in the first 6 to 12 months, I would imagine.
That's right. We need to do all the infrastructure work up front. And electrical, like you mentioned, is hugely important. Typically, we're adding new sub panels into the units. Sometimes we have to upgrade the service that's coming into the building. But again, this is where we've been able to value engineer quite a bit. And let's take Washington, the state of Washington, where I'm located. Our average electrical scope for adding that new sub panel is about $3,900 to $4,000. Retail, that's at least a $13,000 line item on the bid. And that's because, we're getting the supplies, but we're also using the right labor. We don't need the master electrician to pull out the old wires, but we certainly need that master electrician to put in the new ones. So simple, it sounds maybe simplified, but that does help us keep costs down. Fire suppression is another big line item for us. If there aren't sprinklers in the building, typically we have to add them to bring them up to the residential code. Those are just some of the early things for us. You talked about the tens of thousands of dollars in construction costs. That's accurate, right? Especially we want these properties to feel and be new for all intents and purposes. The bones in the inside are old, but we're replacing, casework, doors, windows, flooring, fixtures, the whole 9 yards. And we're usually adding kitchens as well. So we typically spend, anywhere from, on average, $37,000 to $45,000 per door in renovation costs. And that includes all the amenities and the infrastructure that we were talking about earlier. There are some projects that break that mold where if it's a newer build, we might spend $12,000 to $15,000 just on more cosmetics if it has a lot of the infrastructure already.
Yeah, it's one of the things that people leave out. It sounds like when people, after COVID and stuff, people are all talking about offices to residential, and you're like, that sounds great. That's a great thing to talk about. But when you think of it, of how an office building is laid out, you know what I mean? What are you just going to have apartments without windows in it? You're going to have, there's no plumbing to all these. It's like centrally going up and down on these certain places in the building. So it's it's a kind of a contractor nightmare, you know what I mean, of how you're going to do it. And I see it's not as bad with the hotels, but it's always something that, you go into a regular hotel, there's not plumbing usually in one side of it. It's usually on the other side, electrical. It's not made for putting in, ovens and stoves and stuff like that. And then you look and you're, okay, this is where all the costs are coming in. And, one thing I was thinking about when you're doing this, and being in, these different stages that I've mentioned before, is when you start a project, obviously you're going to have a team on the ground that I imagine that you vet, that what team what is your kind of in-house team? Do you have part of that that's going out kind of on site almost and in that market until the project's over? And kind of talk a little bit about that if you don't mind, because this is a huge undertaking. We're like majorly renovating 100 to 200 units.
Yeah, there's two critical teams that make sure our projects operate successfully. Actually, I'd say three. It starts with the acquisitions team and the diligence. You asked earlier about the diligence we do. We're doing full, solar scopes. We're doing, infrared scanning. We're sometimes doing invasive, getting behind walls to try to figure out where the infrastructure is. But certainly acquisitions diligence up front is critical. These are existing structures. We've certainly had surprises in the past. I feel like the unknown unknowns has gone from here to here. And so we know what to look out for. So we try to accomplish that up front. Then we've got our planning team. That's kind of the second of the three teams that I'd say that's so critical. Coming in, making sure we can get permits like we were talking about earlier, so we can start on the projects. And we understand, what requirements we're going to be held to from an energy code perspective, et cetera. The third group is our construction management team. So we have an in-house construction management team led by an industry vet with a couple decades of experience. And those are the folks that are, going out to market, triple bidding to get 3 bids from general contractors on the ground, having a fixed bid, having a robust scope of work with, that's informed by good functional design, and our asset management team coming in to help us build to the market and the specs in the market. Once we kick the project off and we close, it's that construction management team that's, checking in on the contractors on a weekly basis, getting out to the projects. We also use some technology, like 360 cameras to do walks that overlay on our plan set so we can stay on top of what's happening on the ground. But it's so critical to deliver these, on time and ideally on or under budget. That's how we generate the returns. For our investors.
Yeah, that's a lot of great information. And once one of these projects is done, let's talk a little bit about your lease up and your property management, because one thing that I should have thought of this before, but you brought it up, is that you were bringing on, because you're about the saturation. And then right after that, you said because of the studios. So, this is, in my years of being a multifamily investor, studios have been a challenging property, depending on where it is. I've never been in like city centers, right? I'm usually out in like secondary markets or something. But this has been a harder unit demographic to rent to and keep tenants in there. I don't know how to put it any differently. And it's like, so how do you manage this, like you were saying, with the lease-up process of bringing on 100 studios? And then bringing your property manager, how do you find a property manager that is versed in that? Because this is something that most people aren't. Most multifamily properties are probably 50% 2 bedrooms, 25% 1 bedrooms, maybe even more, in 5% studios. So
that's right. When we go into a new market, we interview 5+ property managers to try to find the folks that understand those that are seeking workforce housing, attainable housing. There's so many different monikers for it. Naturally affordable housing, lowercase a affordable, whatever you want to call it. We do try to find the property managers that have experience with those type of communities. We benefit in our lease-ups benefit from just natural affordability. We're usually $300 to $500 less per month than the next cheapest thing. Now, the units themselves are smaller, but we've got all the hotel amenities too. So I was just out at our property in Olympia yesterday, and we're walking 16,000 square feet of ballroom space that we're transforming into fitness club with indoor pickleball and golf simulators, walking trails. Even though your room might be 300 to 500 square feet, there's a lot that you can do with these communities, and that attracts folks because they're naturally affordable. So our lease up time frame, anywhere from 3 to 5 months, I'd say, for a 100 to 200 unit property. On the high end, maybe 6 months. There's been some weeks, for example, last year, one of our properties in Tacoma last spring, it was 109 units. We signed 19 leases in 1 week, which actually gave us pause and said, well, maybe we need to adjust our pricing here a little bit. But just the response is pretty incredible during lease up. And then you mentioned retention of tenants, just that, stereotypically, when people think of studios, they think of higher turnover. Let's just call it what it is. The first hotel conversion that my partner did, was in 2019. That property has stayed 96 to 98% occupied in a 92% saturation market. And the average tenancy there is 19 to 20 months, whereas I think the nationwide average is about 15 or 16 months. So that's the first one we did. It's the one that has the most cured data that we can look at over time. But generally speaking, we see that people, they stay, they love the affordability, they like the community, they like the locations. So that helps on the resident retention.
Yeah. The one great thing about the hotel conversion piece as well is that there's always enough parking. I mean, obviously when they were built initially, they have enough parking for these units, at least 1 car per unit, which is with older apartment complexes, of all sizes, from 3 units to 300. I mean, if they were built in the 60s or before, or something like this, or even the 70s and before, there might be a lacking of that. And that becomes something that you can't just add new parking on that easily to most properties, especially if they're inside if it's like almost like they're inside almost like a city or town center, you know what I mean? And you're kind of stuck with that. And it's an ongoing issue that can never really be corrected. One of the other things I saw when we were speaking, and I was reading about this before, if I had other people on the show, and it would be something where, I'm a huge fan of yearly leases, but I'd have other people on the show that might be short-term people and short-term and medium-term type investors. Has there ever been kind of a notion or an idea, or has anybody ever tried to explain to you to go into a short-term or medium-term type strategy after completion? Or maybe you don't have to do, I don't know, is like a different way of achieving this conversion, but also keeping it almost as a hospitality property, I guess you would say.
Interesting. So would this be more like kind of extended stay model, or like a corporate leases? Is that what you have in mind?
Yeah, well, I had a friend of mine. I don't, like I said, I've never invested in short-term rentals, but I have a friend of mine that has done this before in more vacation areas, let's just say, and down here in Florida. And it's been one thing that they've done. And if they saw the same deal that you were seeing, they would have, depending on the area, of course, they would have a different business plan for it. I don't know if that was ever, personally for me, the yearly rentals and keeping that occupancy and the renewals high is the whole business plan. And that's what I would go for. I just didn't know if anybody ever came to you and or it was ever floated as going into more of a short-term or medium-term type business model?
To be honest, no, we haven't really explored it. It's not something we have experience in. We do try to play with the lease lengths to just, smooth out the renewal curve so that we don't have all our leases renewing at once, right? Since we have that, 3 to 5 month lease up. But, we're not looking at, weekly rentals or monthly month-to-month rentals, from the get-go. We're similar to you, Charles, in that we like the yearly leases.
One of the things that we kind of brushed over earlier was on the acquisitions. When you're looking at properties, and as you said before, these are usually selling because they're businesses per se, and they're selling at 4 or 5 times, earnings, whereas real estate might be 7 or 8. You know what I mean? Multifamily, let's just say, or more. And how are these hotels usually flagged beforehand? Are they just owned independently? I mean, how is that? Is that how we kind of play into your acquisition process?
It depends. So we've bought all different types of flags, from independents to quality inns to Marriott Residence Inns. I'd say, kind of on the other end of the spectrum. One thing that you and the audience might find interesting is just the natural death cycle, that death spiral, I'll call it, that hotels go through. So for those who don't know, the flag, the franchisor, right? Call it Marriott in this case, has certain brand standards that they have the hoteliers, they need them to meet, right? So they want the carpet, they want the countertops, the fixtures, the lobbies to all be consistent, right? If you go into a Courtyard Marriott in Iowa and you go to one in LA, they're going to look and feel similar, right? And that costs money, obviously, to refresh these as they change their brand standards. These franchisors refer to it as a performance improvement plan, or a PIP. Now, post-COVID, hotels have not been doing well, right? Luxury hotels have kind of come back, but the travel budget hotels have not come back. And imagine, your business is suffering. You're not getting the NOI. You're not getting the income that you used to. And then you get hit with a PIP and you have to come up with a few $1 million in CapEx. As a hotelier, it's hard to make that pencil. And typically what you'll do is you'll drop a flag, you'll drop a tier. And so but then when you drop a tier, you might still face the same issues. You might still have challenged income. You might have debt maturities, and then you might drop a tier even more. And so we're typically buying these when they're quite distressed, whether it's debt maturities, whether competition down the street has taken a lot of their business, because that's something that's easy to do in the hotel game, or if they're just multi-generational, families that have owned these assets, they're just ready to move on. So we're typically buying these hotels that are distressed, and this natural death cycle is something it just happens in hospitality, because it's not too hard to go build a brand new hotel down the street. And we've obviously had these changes post-COVID in the way that Americans travel, both for pleasure and for business.
Yeah, that makes perfect sense. So it's really, you have well-located properties that they're not the highest and best use. You know what I mean? And so you're switching it to something that's going to be better for the community and, better for investors that are involved with that property. What are some of the common mistakes operators make, let's say, when they're converting hotels to apartments? And I know you've learned from a lot of your mistakes. As you said, you changed everything around from closing up that inspection box and the unknowns. But have there been other mistakes maybe you've seen you guys have made, or other operators in the space have made, that is really something that a normal apartment investor buying something that's already a multifamily property might not even be aware of if they were going to do the same thing?
Yeah, there are a few. One is, I think the one that folks make most commonly is certainly overpaying on the acquisition. That's not just in hotel conversions. People overpay all the time. The second is underestimating the CapEx. These are expensive projects that take a lot of work. And we've picked up some distressed properties from other folks who have tried to convert, and the most recent one that we picked up, our construction budget is 5 times what theirs was. Like, we saw their original underwriting. And so, folks think, they see the underlying fundamentals of the dislocation in value between hotels and apartments, and they think they can do it, and it's going to be like a value add. It's not, especially when the jurisdictions come in. And so that's kind of the third challenge. Got to make sure you can have change of use. You're not going to get your building permit and as a multifamily to be able to do these updates unless you have that. And that takes time and it takes education. And so I've also seen other projects out there that have been kind of languishing and working their way through the permitting process for 12 months. And man, if you've got a loan on that project or you've got stale equity, that's a huge drag on your project. So we won't buy them. And now we've bought ones in the past where we haven't had permits in place, and we've suffered through them, or maybe we've made it as an intentional decision and we've kind of understood the risk because we were able to negotiate and kind of mitigate that risk through some other, financial means. So that's another category. I think, one is also just doing projects that are too large, oversaturating the market. Lease-up velocity is so critical. One thing that we do to try to mitigate that is, opening in phases. So whether that's floor by floor, building by building, we try to release units in waves so that everything's not all delivering at once. I'd say, the last thing is just making sure that the hotels are vacant before you start and just jumping right in. Don't try to manage hotel operations alongside unit turns. I think other groups that I've talked to try to do that to have some revenue coming in. It makes it complicated for your contractors. It's not a great tenant or hotel guest experience. And then you can also run into some issues where you need to evict what you thought were hotel guests, but are asserting rights as tenants.
Yeah, especially if you've already changed the use of the property, and now they're saying, well, now we're tenants. Yeah, we can see that.
Exactly.
One last thing before I give you the floor about telling us about yourself and Sage and how we can contact you is these being tens of thousands of dollars, as we said, $30,000, $50,000 a unit. How are these deals usually capitalized? I mean, how much are you taking on debt? And are you raising all of this CapEx up front? Because I would imagine the cost of the unit and the cost of your renovation is probably, it's probably 50-50 out of the whole cost of the project, right?
Yeah, you're spot on. Typically, we're spending about the same on development as we are on the acquisition of the units up front.
Okay. And you're raising that up front? Is that done by debt from local lenders or something like this?
Yeah, so we raise equity through our Evergreen Fund. So that's the equity that comes into the deal. And then we'll work with lenders to get, development debt. There's kind of two categories of lenders that we work with. We'll work with the typical debt funds, higher interest rate, maybe a little bit higher leverage, or we'll work with local community banks or credit unions, maybe with a bridge to perm product. In terms of leverage, call it 65 to 70% loan to cost upfront. Now, once we stabilize, that drops into the 40s from a leverage perspective, usually 40 to 45% leverage because of the increase in value. The way these loans are typically structured is it's 100% of the construction costs and a much lower percentage, call it 50% of the acquisition cost, maybe a little bit less. These lenders also require us to fund interest reserves and operating expense reserves up front. And so we're raising all of this up front. We're capitalizing the deal. And, if all goes to business plan, also with some buffer, but if all goes to business plan, these should stand on their own. Everything's raised up front. We execute on our business plan. Our contractors get bank draws. They get paid from the bank. And then, we open up and the property, starts generating enough income to cover its debt. Then we look to do a cash out refinance, recoup our equity and deploy it into our next project. We typically hold our business plan is to hold for about 5 years for these projects.
Interesting. Yeah, that's fantastic because it is more of a construction process versus a renovation value add process for sure.
Yeah.
Ryan, thank you so much for coming on today. How can our listeners learn more about you and Sage?
Yeah, certainly. You can go to our website, sageinvestment.com, to learn more about us. You can reach out to me at ryan@sageinvestment.group. It's a different domain. We haven't switched our emails over yet. Or you can find me on LinkedIn and feel free to shoot me a message.
Thank you so much for coming on today. We'll put all those links in the show notes and looking forward to connecting with you here in the near future.
Awesome. Thanks so much, Charles.
Thank you.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.